Let me start off with our MLive Pulse question. And to me, it kind of goes hand in hand, but what's a bigger risk for the markets? Is it recession or is it inflation?
Well, they sort of go hand in hand, don't
Yeah.
they, really? And so that's the key risk, really, for markets at this stage. You know, markets are already accounting for what we've seen so far and the expectation of central banks accelerating the policy stance, which obviously, you know, I think we'd all agree central banks really have been behind the curve, really playing that balancing act between not wanting to stifle recovery, but wanting to keep inflation in check. Unfortunately, it hasn't quite worked. And so they're having to accelerate the interest rate policy. So for markets, from a sentiment and from a volatility perspective, we certainly see the next stage of this around risk is recession, and what's the probabilities of recession. It's certainly looking more likely to us that the US could go into recession by the second half of next year. That doesn't necessarily guarantee a global recession, but you know, obviously Europe is struggling and the UK is struggling. Australia may well avoid an actual recession in technical terms, but we're certainly going to see quite a significant growth slowdown. So we've got the world tracking at around 3.5% growth as we are now. You know, that's going to get down to about 1.25% growth, we think, into the middle of next year. So a pretty sharp slowdown over the next 12 months, driven by those policy settings. What has been interesting in this year of transition, where we're seeing, you know, economies have been doing quite well and now interest rates are having to catch up, is that really the world, in particular the US, has been quite resilient. And that's somewhat confusing because you'd almost be expecting to see the data deteriorating a lot more than we're currently seeing.
Alternative assets is one place that you're looking to hide or to look for alternative opportunities. Can you tell us more about that? Because usually you see them thrive in a period of high liquidity. Of course, we're seeing those pockets of liquidity pressure now. Yeah,
look, we've upped our asset allocation towards alternative assets. You're absolutely right. Alternative assets, by their nature, are not liquid. So it's a 3 to 5 or 7 year time frame, and so it has to be appropriate for clients with that sort of time frame. But we've almost doubled that allocation because these assets, you know, such as private equity, infrastructure, for example, really have low or no correlation to global markets in the short term. They're not going to get, you know, engaged with the volatility we're currently seeing, and we think that makes a lot of sense for clients. It also fits neatly into some thematics that we're running with for the next decade, which is obviously, you know, this big focus, particularly on infrastructure. You know, obviously COVID has accelerated the use of online and e-commerce. That's going to continue in our view, and therefore, you know, infrastructure assets such as data centres, distribution, logistics, you know, we like those thematics, and that's really where we're basically targeting those. So, you know, the alternative asset class allocation.
How much of that is inside China?
Well, not a lot, to be quite honest with you, at the moment. Look, there certainly are infrastructure assets that have got, you know, Asian exposure generally, US, Europe and Australia. I think we're certainly continuing to take a pretty cautious stance from an investment perspective for China. We don't know how long the impacts of the lockdown, the COVID lockdown, is going to take. We certainly have no doubt that the Chinese authorities are going to be pump priming their economy. We've got a Politburo meeting in July, which we're expecting to see some more announcements on policy around how they're going to support the economy. And then going forward, you know, we'd be expecting to see more announcements as well. So you're having seen China grow at about 6.5% coming out of COVID, and now at 4.5%, we would be expecting to try and target growth back towards that 5.5% stated objective.
Exactly, Martin, especially with all of that potential stimulus coming from Beijing. How much confidence will that give markets at a time when, as you said, the US could potentially fall into a recession and that the European economies are not doing that great as well?
Yeah, that's a really great question, because at the end of the day, you know, China's the world's second largest economy, and if we start seeing it recovering, you know, that should have, you know, some benefits in terms of consumer and investor confidence. So it may well be that we see, you know, some economies like the US and maybe Europe go into a shallow recession, certainly not a deep recession, but the rest of the world does not. And that could well be because of the stimulus that Chinese authorities put in place, along with obviously an improvement in sentiment that the Chinese economy is starting to recover. So I think that's a really interesting dynamic over the next 6 to 12 months for sure.